Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And in this webcast series, we talk all about the tools and the indicators that are available on a trading chart that a trader might recruit in the planning and placing of a trade. And today, I wanted to talk about how there are some studies that seems like everybody knows them already, and then there are some that seems very few traders have actually discovered them just yet. And we're going to be talking about one of those types today. We're going to be talking about an indicator known as the stochastic distance oscillator. And in my preparation for this video, as I always do, I go watch what other people are talking about on YouTube. I like to see the sort of flavor that other traders bring to the discussion. And what I discovered with this one, because this is kind of a new indicator, it was only introduced in 2023, there were only two other videos on YouTube. There was one that I did about a year ago, and there was one that my chat support guy here, Mike Fairborn, did about a year ago. So this is kind of a Schwab exclusive. If we want to understand and trade the stochastic distance oscillator, we only get that from Schwab Education. So this is going to be a fun discussion. I'll talk about how the indicator is built. Then we'll talk about how it might be used. A lot to cover before I can get to any of that, though. Let me first of all say hello to everybody who's already chatting in out there in YouTube. Hello there, Hope and Frank, Kevin, David, Jack, Scott, Chris B, Jay Richardson, Sharon, everybody else. Thanks for joining us week after week. I always do appreciate your attendance, your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these things. But if you'd like to be here in the live stream, this is a Friday webcast series, and we kick things off promptly at 1 Eastern time. Love to have you here in the live stream audience. And as I already mentioned, my very good friend Mike Fairborn's hanging out in the chats with all his knowledge about these indicators and others. He's going to be addressing any questions that I can't get to during the flow of the presentation. Thanks for having my back there, Mike. And Mike and I would like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters from Schwab on X. It's the best place to connect with us in between these live streams. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. But let's get into this relatively unique discussion of a relatively unique indicator known as the stochastic distance oscillator. As we do, of course, we need to consider the risks associated with investing and trading. Bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so with that said, let's set the agenda for today's discussion. Now, this webcast is part of an ongoing series of webcasts that are tied from one to the next. So what we're going to be doing at first is having a look at existing or current trades in our paper money portfolio, see if any of those need some attention today. We're going to get an update on one that was closed out during the week since our last discussion. Then we'll take a quick peek at what's going on with the S&P 500 through that, what we call our trend value momentum lens. Three different technical indicators that a trader might use to sort of gauge what's going on with the markets. And then finally, we're going to plan and place a new trade using the stochastic distance oscillator. But I want to talk about how it's built, how it might be used to identify trade signals. And then we're going to plan and place that trade before we're done. So let's go right to Thinkorswim desktop. We have two current positions right now. We actually had three. So one of them closed out during the week. So first of all, we have Boeing. Boeing, we have 25 shares purchased at 222. We're down a bit, down to 217. So underwater about 118 bucks on those 25 shares. So let's revisit the logic of this trade. Now, this was last week's trade where we talked about the Chandi momentum oscillator. And we noted that oscillator had gotten down into the oversold range, started to tick back up, potentially signaling a bounce off of an apparent low. And we took the entry purely on the evidence of the oscillator, which is the way that some traders approach things. Just maybe in their view, simplicity carries merit. But in any case, the plan here was we'll take that trade. If the oscillator rises up to the zero line, Then we'll take any profits that might be there. That'll be our planned target exit. On the other hand, if the stock fails, if the bullish rally here fails, we have a stop place just below recent lows, which is a common way to place stops when using oscillating indicators. And it looks like since we took that trade, there has been a retracement. It's interesting that we came down pretty close to recent lows, but now we're starting to find a little bit of strength again. That one is okay. It's a little bit underwater. We'll see if it can work its way up toward our target, but nothing signaling an exit there. Next up, we have Super Microcomputer, SMCI. We own 100 shares, purchased at $44, trading now at about $52. So we're up in the neighborhood of 20% on that unrealized gain of $830 at the moment. So here was the logic of this trade. So we'll bring up SMCI. Let's come up to our studies, load our study set for the SMCI market forecast. Here's that trade. Now I want to pause the discussion here for just a moment because not everybody watching here, right? Let's see about 170 people watching the live stream. There will probably be 1,000, couple thousand, maybe more than that, people that watch on the archive after the fact. Not everybody was here to see the setup for these trades. So if you want to go back and revisit that logic, if you don't know what the market forecast is or what Chandi had in mind with that momentum oscillator, you can go to our channel. Go to the Trader Talks channel on YouTube. Do yourself a favor right now. If you haven't subscribed to our channel, you can go down, click on the subscribe button. It doesn't cost anything. It only takes a second to do it. But this is where we house those previous webcasts. It's also where you can join live streams and you can do searches for topics of specific interest. So, for example, if I wanted to go see the previous webcasts in this series, our Advanced Charting Techniques series, I could go to the playlists. Here are all of our series, quite a few of them, present and past. And if I go about halfway down, there's my Advanced Charting Techniques. I can click on View Full Playlist, and you'll see there was last week's discussion introducing the Chandi Momentum Oscillator. And if we look back a little bit further, Trend Value Momentum, which is what we're going to be talking about shortly. So that's where we can go back and look at the history of these trades. So now let's get back to this position. So with SMCI, we were using our market forecast cluster. We did a scan for a pretty rare, it's an uncommon signal. It only happens a few times a year where we get all three of our stochastic lines on the market forecast below 20 at the same time. And we had that back here on, what was that? That was August 22nd. We took the trade, which was just a day or so after what we call a cluster. All of those reaching down in the oversold range. Now, in this case, the trade, it started working in the right direction. We have a stop down below recent support. The stock kind of stumbled a bit, came back down to that recent support line. That's always interesting to see where you think the price floor is likely to be, and then for that floor to kind of demonstrate itself again. Great. But we've since seen a nice rally off that low. Stop is down here. What a trader may consider doing at a point like this, maybe they move that stop up. What if we were to move that stop up? Looks like a most recent support. So previous highs seem to be around that 47.75. As we're making our way toward our target, maybe the trader takes this opportunity to try to mitigate that downside. Initially, we started off with loss potential. Maybe what we're now doing is moving into profit preservation territory. If we move it right up to previous highs that may be acting as a new price floor, what that might mean is that if price fell, it might kick us out of the trade right at the floor and then move back up again. So let's go a little bit below that. What if we go down to about 45? That's going to be below our, above our entry price. I'm going to replace that stop. Now, our stop, even if we move that up, it's not a guarantee that we'll sell at exactly that level. But how about we put that up there? Yeah, it's going to be about 45 and a quarter, close enough. It's just below those recent highs. I'll show you what I'm talking about if you didn't quite catch that. But let's send off that modification of our order. So our stop is no longer down here. If you didn't know that, if you didn't know that you can just move your orders right here on the charts, you can do that on Thinkorswim. I'm going to remove this one. This is a drawn line. I just drew that in. So I'm just going to right-click on that, and let's remove that drawing. Yeah, but if you're not seeing your orders on the chart, that's under chart settings right up here. Just check the box there on the general tab for show orders. And we can change those orders there. So I think there we've moved that stop. It's now up. It's this support is kind of seems to, at least in the near term, proven itself. It looks like there may be a new support level off of these highs back here and carrying through these here. That's what I was eyeballing and moving that stop up below a new potential price floor. There we go. So there's our two current positions. We have one that was just concluded though. Let's have a look at what happened here. This is our TMUS trade. And this one was placed using our TVM strategy set, our trend value momentum strategy set. Now, if you're not familiar with this strategy set, the trader here is looking for a combination of three factors. First of all, a bullish trend. Second of all, apparent value opportunity in the short term. And then finally, bullish momentum from our momentum oscillator. So the trend confirmation in this set is for a 50-period triangular moving average to be above the 100-period triangular moving average, a short-term moving average or an intermediate-term moving average being above the longer term. So that's a potential confirmation of trend strength. It has changed since at least the trend itself or price itself hasn't really kept with that trend, but nothing's perfect. Down here is our value oscillator, and a common interpretation with RSI in a trending stock is even if RSI dips down below 40, that can be down in an oversold range. Now, traditionally, it's below 30, but in a strongly trending stock or a persistent bullish condition, some traders will nudge that up to 40. And we did recently have our RSI dip down below 40 and then start to rally. Now, finally, we have our momentum oscillator. And with that, we've been applying the MACD, where we're looking for highs representing strong bullish momentum, shifting bearish as we start to come down, lows representing strong selling momentum, shifting bullish as we start to roll up. So we started to see what we refer to as a red shift down here. And that momentum seemed to be rising. At the same time, we had a dip below 40 on the RSI with our trend moving higher. We took a trade. Now, not all trades work out, so we had a plan in place to take losses, and that's what's happened in this case. We broke down below that low. We had our stop below that low down here at 230, and we hit that 230 stop. So we've been stopped out of that trade. So here's a question. We don't yet see a fresh signal, but our trend confirmation is still there. The RSI is solidly below 40. It's actually at its lowest levels of the year. And those very deep dives, for some traders, they see those as potentially some of the most valuable signals. Because if we can get a reversal from those deep dives, we might see a rapid reversion in the other direction. So my question here is the trader still open to trading the same security that just burned them if we get a fresh signal? By the way, on this one, we've been burned twice. We actually took another trade right back here and got stopped out. It was a small loss. We've had two small losses. There's my question. I don't have the answer for every trader out there, though. But what is your set of rules? Is it sort of the fool me once, fool me twice sort of a thing? Or is it, hey, if it still meets my rules, I might take a third entry or a fourth entry? Anyway, so that trade is over. So let's have a look at what's going on with the S&P 500. Let's switch over here. With the S&P, each week we look at it through the same lens. We look to see what does the trend appear to be. I'm All right. When we've just recently, when I mean recently, I mean today hit all-time highs again on the S&P 500. Is it going to be any surprise that the trend still looks bullish? Yeah. So this is still, yeah, okay. Jay Richardson, or let's see, Gazelle says wait for confirmation to enter, but still open to the possibility. Okay, good. Um, but I think you're exactly right. If a trader has a designated system for trading stocks, there's sort of hopping back in because we want our money back. What do we call that? We call that revenge trading. But there's also just disciplined re-entry because there are valid signals on the chart. And we don't hold a grudge against the stock because the stock doesn't hold a grudge against us. If we happen to be profitable, that stock is fine with us making additional profit. If we happen to lose and we hold a grudge, stock doesn't care. It's going to do what it's going to do. Okay, Jay Ritz says for me, it's usually fool me once, fool me twice. So once I'm out on a loss, I move on. That's fine too, right? There are thousands of stocks out there. If we want to say that one has to prove itself for a while, I'm going to put that one on the back burner. That's all right too. Okay, but what's going on with the S&P trend? That looks like just check. Yep. 50-period triangular moving average is above the 100. What's going on with the RSI? It's been strengthening. Is there value in the short term if we're defining that as being below 40? No. Does that mean, oh no, it's scary? It still looks bullish. It just may not be optimized for some bullish traders. And finally, our MACD is still showing, you can see if we squint really hard, there are little tiny green histogram bars sticking above the zero line. Yeah, momentum is with the bulls, but interestingly, not a ton of it. So what some traders may conclude from this is trend looks bullish, but maybe there's some hints here that we might be reaching short-term peaks, maybe pump the brakes on big new positions would be a typical interpretation of that, or just sort of scale down those positions if we have a new signal on a chart. But I'm just going to go forward with this discussion under the premise that let's say that our trader still looks at this and says, well, look, all things considered, still looks pretty bullish. So I'm going to go, let's learn about the stochastic distance oscillator and let's trade it. All right, just as an example. So what I did before the webcast started is I ran a scan that I'll be showing you more toward the end of the webcast to show you how I found a trade candidate here. But I'm going to be using BR to introduce this indicator. First thing that we need to do, though, is clear off our studies. So let's remove all the studies from the trend value momentum study set. Nice clean chart. And that leaves us with Broadridge Financial's price action, which has been pretty choppy all year. Choppy, up and down. But we're going to be using today the stochastic distance oscillator to plan and place a trade on Broadridge. So let's add it to our chart. So I'm going to come up here to our Edit Studies icon. I'll add it to the chart. We'll talk about how it's built. What I'm not going to do today is go deeply into the algorithm that generates this indicator, because there are some, like last week, I showed you the algorithm. We plugged in some hypothetical numbers. We got to see exactly how it's built because it was a simple algorithm. There are some other ones, though. They're pretty multi-layered, multi-factored. It can take us deep into the weeds and use up all of our time. I'm not going to be explaining the algorithm today. If you want to Google it, you can do that. But I will be explaining conceptually what's going on. All right. So let's start typing in stochastic. We could go down in alphabetical order, but if we type in STOCH, let's just go down to the stochastic distance oscillator, add that to our chart. And as we do, this will start to give us some insights into how this indicator is built. Some key numbers here, and then the word exponential. So some of you already know some of the implications of what we might be talking about with exponential. But let's go ahead and apply this to our chart because I want to see these same details, but I'll show them to you up here. Okay. But here's our oscillator. Mary Burns says you need to know what the stop sign means and how it was made. I don't know why it has the shape that it has, but Anyway, yeah, here's our oscillator consisting of three lines. We have an overbought, we have an oversold. Much like so many oscillators, we kind of have a theme going for the last 3 weeks. We've been taking a deeper dive in some of the oscillators that are available on Thinkorswim. But between the overbought and oversold, we see this oscillating line moves up and down. That is our stochastic distance oscillator. And the 40 and the minus 40 are just intended to identify potential extremes and signal bullish and bearish entry and exit signals. But let's talk about how it's built. Really, what's behind the logic of this trade. So this was introduced just in 2023 by a gentleman named Vitaly Apparini. But I'm going to go up here to our edit studies to sort of explore the guts, the inner workings of this oscillator. If we click on the little gear icon, we get this breakdown of those 12 numbers, and this gives us a little bit more context. So the first one that we see is the number 12, and it says momentum length. So here's the concept behind the oscillator. With so many short-term traders, really what they're trying to identify are extremes in price, either high or low, because we've all heard this phrase, buy low and then sell high. And in the short term, that might be exactly what the trader's attempting to do, buy low and then sell high. Well, how might they identify that? Well, Vitaly decided, well, why don't we just look over a period of time and look at the distance traveled high to low, and then see if recent highs and lows are extreme compared to historical highs and lows. Because sometimes we get just sort of noise up and down. Other times the stock really goes for a run up, and it might be an extreme high, and that might not be a great time for someone to be buying in the short term. Or it might have run recently down to an extreme low, and maybe that represents a short-term value opportunity. So we're looking at distance traveled. Guess how long? Well, we're looking at distance traveled over the last 12 days. That's what the 12 means. And then we compare the last 12 days to average movements of 12-day periods over the last 200 days, which is basically the last year. So we're looking at the last 2.5 weeks, and then we're looking at the last 2.5 week periods over the last year, and just seeing if the most recent activity is extreme compared to an average. Now, whenever we look at something over a 12-day period, it's actually not a very big data set, and a single day can have a big impact on the indicator. So what do we do sometimes to smooth that out? Well, we introduce moving averages. Yeah, so in this case, we use an exponential moving average, and we smooth the trading of the 12 days using a 6-period moving average length. Okay. Basically, it's just intended to smooth out the line so our oscillator doesn't go like this. It'll just more gradually move up and move down, maybe making it easier to spot extremes and potential highs and lows. And then finally, we just have the overbought and oversold ranges that are defined as comparatively extreme departures over that 200-day comparison time frame. Anyway, that's a lot to talk about. If you want to go back and revisit that logic of the construction of this indicator, at least it's on video. It's going to be added. It's going to be included in the archive that is scheduled to be posted to our YouTube channel. You can go back and rewatch those last few minutes if you like. But that's the concept of how this is built. We're looking at recent distance traveled to see if we've reached extremes, either high or low. So now let's see how that might be traded. This is more of the fun stuff, right? It's interesting to see how the thing is built, maybe more interesting to see how it might be traded. So as with so many oscillators, go ahead and chat in. Why don't you let me know some of the oscillators, maybe the ones that you've just learned recently, like last week, the week before, or just some of the big familiar ones you've known. But chat in some of those that have these overbought, oversold conditions. As you do, I'm going to explain this one. It's going to probably sound pretty familiar. Yes, what our trader typically looks for is for our oscillator to reach an extreme. Now, in this case, it's defined as reaching a value of -40. What that means is that over the last 12 days, we've had a strong sell-off it doesn't fall within normal ranges. It's starting to push out to unusual distances. So, for example, if you look at this period, you can probably understand why over 12 days, the trailing 12 days, this may be seen as reaching extremes. It's not a typical 12-day distance traveled downward. And if we get down below 40, that can set up two potential entry signals. The first potential entry signal is just for the oscillator to start climbing back up again. Maybe this one's going to be a little bit clearer. This one kind of went zip, turned right around. By the way, one other little navigational tip for using the tool is rather than squinting and wondering, well, on a given day, is it below 40? I can't tell. Look at the numbers right here. See that number in red that's moving around as I move my cursor around? That is the day-to-day value of this oscillator. So if I come back here, you can watch that number as it falls. -17, -27, -38. So the first day where we get below -40 would be right there, November 1st of 2024. So what some traders will watch for is they'll look at that number. If it keeps going down, getting more and more negative, it's wait on that signal. So you'll notice on the 4th, it's lower still. And then what is this day? We go from on the 4th, we're at -44. On the 5th, we're at -33. Obviously, that's less negative. In other words, we've swung upward. Now, in this case, that swing accomplished two things. It started going up, which is potential signal number one, but it also crossed back up above -40, which is potential signal number two. So in this case, both of those signals happened to coincide on the same day. There was an entry right here, and both of those were as the stock was really strengthening off these lows, probably following that earnings announcement. All right, looks like a lot of you chatted in. Hope says, why 40 for overbought and oversold? So Hope, that's totally legitimate question. Really, for me to show the math of how the 40 or the -40 is generated, I'd have to get into the algorithm, and that would just take us too deep in the weeds. It would take up all my time. But all I can say, here's a sort of a broad but simple statement about it, is because it's unusual. Getting down to -10, not unusual, happens all the time. Getting down to -40 doesn't happen very often. On an average stock, it probably happens between 2 and 4 times a year. And what we're looking for here are extremes. So it takes a larger downward move to get us down to -40 than it gets down to -10, according to the calculation of those numbers using the algorithm that Vitalik created in 2023. Okay, that's it. All right. Anyway, yeah, some really good additional oscillators. If you want to learn about other oscillators that use this sort of overbought, oversold approach to trading in the short term, RSI, CCI, yep, good. That's, Jim and Jay Richardson and Posh and Chris B. Taylor says, is it based on a standard deviation? Nope, that's not part of this equation. Nope, it's just average distance traveled over the most recent 12-day period versus the average distance traveled basically over every 12-day period for the last 200 days, smoothed by a 6-day exponential moving average. So yeah, standard deviation, it's a similar concept, but it's not explicitly included in that algorithm. Okay. Now, so we've learned one signal. I've hinted at another. Let's look at a better example of the second signal. So here was a near miss. Ooh, look at this. Squint your eyes, but also keep your eye on these numbers right here, because doesn't this little, you notice how it looks like we might have crossed over -40 right there, but maybe not? Well, as I follow the numbers down, -28, -38, -39.82, and then nope, minus 36.9. This was a very near miss, not considered a valid signal by those looking for a dip below 40. So we get a little bit of a blip upward, and then we definitely go down below 40 here. So for some traders, they may wait for a crossover back above minus 40, and that might be their entry signal, which in this case would have been about here. Would have been about that day. I'm going to remove that one though. But traders are looking for a little bit earlier, maybe a little bit more aggressive signal. Or just let me zoom in on this. So here we are below 40, and you can just see visually there's an uptick right there. Or you can look at the numbers, and you'll notice we become less negative. So we're going down, minus 47.5, minus 49.17, and then we go back up to minus 47.5 again. So right here, there is a turn. So we're below minus 40 and then tilting upward, and that can generate potentially an earlier signal. Earlier does not always mean better. Sometimes it means premature. But there's a couple of, it's a small distinction, but a real distinction that are used. And sometimes there can be, instead of these coming just bang, bang, back to back, there can be a delay between those signals. Some traders may not want the earlier signal. They may want to see more confirmation, maybe more up days dragging that oscillator up from those extreme lows. But in any case, there are our two signals. So if those are our two entries, when might the trader take profits? Well, sometimes they use price. Other times they'll use the indicator itself. So let's go back to this oscillator. And as we know, now that we understand the construction of the oscillator, we basically need this to reach extreme lows over at least a 12-day period. And in doing that, price has come down. You'll see these signals are generated after a move to the downside. See, here's a move right here. Now, we've already started moving up, but these are preceded by downward moves in price. Right? So when a signal is generated, the trader may take the entry on the oscillator, but use price as their target. So if we're getting in at apparent lows, maybe a return to previous highs might be the target. So in this case, the trader might have decided if we can get back up to those highs, and actually with that earnings boost, it got there pretty quickly, maybe they take profits. Other traders think that approach may be leaving potential money on the table. And so they'll look for the oscillator itself to start showing weakness. Not just getting back up to previous price highs, but watching the oscillator to get above positive 40 and then start to turn. So in this case, it might have been, let's orient ourselves here. Right there, we got a bit of a bearish turn above 40, and that looks like that coincided maybe with about this candle right here. Was it an improvement in this case? Maybe a little bit. Is it always an improvement? Nope, not always an improvement. As a matter of fact, it's not always the case that either of these targets are hit. Let's see if we can find an example. Here's one that may have come up a little bit short. Yep. Whether we took the immediate turn or the crossover the minus 40, maybe entering here, looking for a return to these highs. I don't know if we ever got there. It looks like we got close. Maybe that was close enough for some traders. They might have taken the profits there, but it might have taken a while to get there. And in the meantime, it's entirely likely maybe this big red candle took them out. Trade was over before we ever got there. So is it a perfect signal? There are no perfect signals. I would very happily bring you that perfect signal immediately the day before my retirement if I found one. Anyway, I think you get the point. So that's the potential management of the trade to the upside, either targeting a recent high or watching for the oscillator to climb up into the overbought range and then turn down again. Now, we just mentioned that we might get stopped out. Yeah, most commonly, this is used in combination with a stop plan. And that is, if we get that signal, we look at the most recent few days and look for the lows that preceded the entry. It might be the same day of the signal. I think this one back here might have been exactly that case. Yep. Yeah. So let's say we're getting that entry. In fact, we had an entry before this earnings. Ooh, that would have taken maybe some traders might have hesitated, but there was a signal anyway. Yeah. But looking to recent lows. So let's say we're in just after this earnings as the price is starting to climb. The trader might look at recent lows. And in this case, it would be even the same day. And then setting their stop maybe at a couple of dollars, maybe a couple of percentage points below that, but having a plan for a relatively quick exit if this doesn't pan out. Now, all of this has been done using the stochastic distance oscillator in a vacuum. And actually, Vitalik didn't intend it that way. As with so many other oscillators, most commonly it's paired with a trend indicator. So which trend indicator might we use? There are lots of them out there. This is a signal that doesn't happen very often. And so if we try to pair it up with like a really fast oscillator, the trend indicator, the trend indicator is maybe just as likely to be going in the wrong direction as the right direction. It's probably out of sync with a signal that's slower to emerge. So maybe a longer term trend indicator might be on order here. So let's do that. Let's add a type of a moving average, right? Now, all types of moving averages might be used: a simple moving average, an exponential moving average, a whole moving average. I'm going to use, like we use with our TVM strategy set, a triangular moving average. This is a moving average that's slowed down even a little bit more than a simple moving average. It's also known as a double smoothed moving average. So let me add that to our chart. And instead of just using 9 days worth of data, I'm going to use 100 days. We're going to look at the intermediate to long-term trend and just confirm that that's moving in the right direction. For a bull, that would be upward if we're starting to get a bullish signal. Now, what we'll notice with Broadridge is the oscillator down below minus 40? It is. Has it started to turn upward? It has. Is the trend line moving higher? It is. So we have bullish confirmation of trend if we're using this as our confirmation, paired up with a very fresh signal on the stochastic distance oscillator. But is price above that trend line? No, it's not. That's actually not a requirement according to Vitalik's original set of rules. Just as long as our trend line is up, price quite commonly is actually going to be below that trend line at the moment of the signal. Look at this one. Look at this one. Yep. Being below the trend line is common because it's looking for quite steep dives against that trend. So let's go ahead and place this trade, but let's have a plan for where we'll take profits and where we'll take losses. So where might we take profits? Well, if we're using, let's use a price objective here. It looks like a recent high might be right up here at about 255. It might be closer to 256. I'm going to round it off to 255. So let's just draw that. Let's draw in a line at 255. But looking to recent highs. Now, we'll also have a plan for the downside if this trade isn't working out. It looks like we have a recent low right here, which interestingly coincides with the lows stretching all the way back months. So how about if we break below those lows? Not only is this signal in severe question, but maybe the trend itself. So let me do this. I'm going to right click on this line that I've just drawn. Let's extend that to the right so it sticks out there to the right. So we're going to put our stop down below that. How about we put it, let's keep it away from that round number of 230. What if we put that in down there at, what should we give it? A couple of percentage points? What's our support? Looks like that's at 231.5. 2% below that would be basically $5 below that, around there. How about we put on our stop at 226.5? That's going to be down here. There we go. Just drawing a line just to represent that stop. Let's make that line red. So there's our plan for our trade. I'm going to make a couple of quick notes for reference point. Let's make an oval there. Let's point out that our moving average is upward trending. And we'll have our target up at 255 and our stop at 226.5. Let's go place our trade. So in this account, we'll typically do about $5,000 on a trade. 10 shares here would be about 2,340. Let's double that up. Let's do 20 shares. So I'm going to right click on our ask price. Let's put in a custom buy order with an OCO bracket, buying 20 shares. Let's fix the broken chain link so it links our buy order with our sell order and matches those quantities. I'm going to put this in as a market order. Talk about that risk as we place that. We have our limit up there at our target of 255. We have our stop down at 226.50. Let me know if I got any of those numbers wrong. I'm going from memory, but I think that's right. We'll make both of those good till canceled. And let's confirm and send this trade. So we're going to buy 20 shares of BR at the market price. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. So we're not guaranteed that just because this is trading around 234.5, that's what we're going to pay. We're going to sell if we can get our target of 255. We're also going to sell, well, not also, but otherwise sell if we get down to our stop at 226.50. That stop carries no guarantee that the execution price, the price we receive, will be equal to or even near the activation price of 226.50. In the case of like a big gap, we might sell at a much lower price. There's no commission here, but there can be on some trades. Let's send that order off. And we have acquainted ourselves with this indicator that really no one else has talked about on YouTube. I did a lot of research there, couldn't find a single video about the stochastic distance oscillator, except from my previous one I did about a year ago and the one that Mike Fairborn did. So yeah, this one's kind of a Schwab Education exclusive. I hope that was helpful to you. We've done what we set out to do. Learned how the indicator is built, how it might be used to generate trade signals. We planned and placed an example trade. So time for me to let you go enjoy the rest of your Friday. But before you go, you also need to be taking full advantage of the educational offerings from Schwab. So just do this. If you haven't subscribed to our Trader Talks channel on YouTube yet, do that right now. You can just go down and click on the subscribe button. It doesn't cost anything. It only takes a second to do it and it's done. Click done. But this is where we house our playlist for our previous webcasts. It's where you can join our live streams right here. You can even do quick searches for, if you want to learn more, if you want to learn, like, let's say what Mike had to say about the distance oscillator. Let's type in distance, hit enter, scroll past the guy at the top, and there's Mike's discussion. This new indicator he's hinting at, we just added it to Thinkorswim in November of 2024, and then he delivered a discussion in December of 2024. So he was right on his game there. Also, make sure that you're following us on X. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. But this is the best place to connect with your favorite presenters in between the live streams. So there's my handle right there. But we can have discussions about serious matters like learning about trading. We can also just talk about things like Elon Musk hitting $500 billion in personal net worth. Reminded me of the show, The $6 Million Man, from back in the early 70s, and how I thought that was mind-blowing. $6 million. Whoa. Anyway, Juan says, what's the name of the study? The stochastic distance oscillator is what we discussed today. Anyway, give me a follow there. That also doesn't cost anything. But Mike, thanks for helping out in chat. I don't believe we saw a survey in this webcast. But if you do see a survey, please take time to fill it out. Thank you to everybody who's already clicked the thumbs up. I see over 150 people still watching and 57 have clicked the like button on YouTube. That's always appreciated. It's a nice pat on the back to your presenter for a job well done. But it does even better than that, gives a boost to the video in the YouTube algorithm, helps more people find these videos, like these rare discussions of the stochastic distance oscillator, and they can learn about tools that are available to them. Anyway, thanks everybody. Go have a great weekend. I will see you next week. I'll watch for you in my other webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.